I am AI Akhtar of CA Ratan Mundra. Welcome to this detailed analysis of an important enforcement order issued by the International Financial Services Centres Authority, commonly known as IFSCA. This order relates to Majortrend Capital IFSC Pvt Ltd, a registered stockbroker operating within GIFT IFSC. Understanding this case is extremely important for stockbrokers, capital market intermediaries, compliance professionals, and businesses operating in IFSC. In this video, we will break down the background of the case, the allegations made by IFSC, the company's response, the findings of the authority, and the final regulatory directions issued. We will also discuss key compliance lessons that every regulated entity should learn from this case. By the end of this video, you will have a complete understanding of how regulatory non-compliance can result in enforcement action even when no active business operations are being conducted. Let's begin by understanding the background of the matter. Majortrend Capital IFSC Pvt Ltd was registered as a stockbroker under IFSCA and was authorized to operate within the GIFT International Financial Services Centre. However, according to the observations recorded by the authority, the company had not maintained the required minimum net worth for its regulated activities. The company had also vacated its office premises within the IFSC and failed to submit certain quarterly reports required under the regulatory framework. These developments raised serious concerns regarding the entity's continued compliance with the conditions of registration. Regulatory authorities require all registered intermediaries to continuously maintain infrastructure, financial strength, and reporting standards. Failure to comply with these requirements can trigger supervisory and enforcement actions. The authority therefore began examining the company's compliance status and operational readiness within the IFSC ecosystem. The order reveals that IFSCA had issued communications regarding the surrender of registration and membership-related concerns. The company had sought time to review its position with respect to its membership status. Subsequently, NSE International Exchange advised the company to commence business operations before a specified deadline to continue its membership. However, despite these communications, the company reported in multiple quarterly filings that its net worth was effectively zero and that it had already vacated its office premises. These facts indicated that the entity was not in a position to carry out regulated activities. From a regulatory perspective, maintaining membership without meeting operational and financial requirements poses a risk to market integrity. Therefore, these developments became a crucial part of the enforcement proceedings initiated by the authority. IFSCA identified three major areas of non-compliance. First, the company failed to maintain the prescribed minimum net worth required under applicable regulations. Second, it did not maintain an operational office within the IFSC, which is a mandatory requirement for regulated entities. Third, the company failed to submit quarterly reports within the prescribed timelines. Quarterly reporting serves as a critical regulatory tool that enables supervisors to monitor the financial and operational condition of market intermediaries. When such reports are not filed on time, regulators lose visibility into the entity's compliance status. Collectively, these deficiencies raised concerns regarding the company's ability to continue functioning as a regulated intermediary and formed the basis of the enforcement proceedings. After identifying the alleged violations, IFSCA issued a show cause notice to the company. A show cause notice is a formal legal document through which a regulator informs an entity about alleged violations and provides an opportunity to explain why enforcement action should not be taken. In this case, the authority issued the notice and later a corrigendum clarifying certain aspects. The company was given sufficient opportunity to present its defense and submit supporting documents. A personal hearing was also granted through video conferencing before the quasi-judicial authority for enforcement. This demonstrates an important principle of regulatory enforcement: natural justice. Before imposing any action, the authority provides the affected entity with an opportunity to be heard and present its side of the story. During the proceedings, the company presented several arguments in its defense. It stated that it had never actually commenced business operations after obtaining registration. According to the company, it had not onboarded any clients, executed any trades, handled investor funds, or generated any revenue. The company further argued that no investor or market participant had been exposed to any risk because business activities never began. It also explained that the absence of infrastructure resulted from non-commencement of business rather than an intentional disregard for regulations. Additionally, the company informed the authority that it had been pursuing a regulatory exit and intended to complete the surrender process. Regarding the quarterly reports, the company acknowledged the delays and informed the authority that the pending reports had subsequently been submitted. After reviewing all submissions, the quasi-judicial authority for enforcement carefully analyzed the facts and evidence. The authority accepted that the company had not commenced business operations and had not onboarded clients. It also noted that the company had vacated its office and appeared to have decided to exit the IFSC ecosystem. However, the authority emphasized that even inactive entities must comply with applicable regulatory requirements. Registration brings ongoing obligations, regardless of whether business has started. Consequently, the authority concluded that the company had violated net worth requirements and infrastructure requirements. While some reporting deficiencies were eventually rectified through subsequent submissions, the original non-compliance had already occurred. Therefore, the authority recognized both the corrective actions taken and the underlying regulatory breaches. One important aspect of this case involved delayed quarterly reporting. Regulatory frameworks require reports to be filed within specific timelines. The authority observed that the required reports were submitted only after the issuance of the show cause notice. Because of this delay, the company became liable for payment of late submission fees. The order records that the company subsequently paid the applicable late filing fees and completed the filing requirements. This demonstrates that corrective action can mitigate certain concerns but does not automatically erase past violations. Regulators expect entities to comply proactively rather than reactively. Timely reporting is a fundamental pillar of regulatory supervision, and delays can attract financial consequences even when the required information is eventually submitted. After considering all facts, evidence, submissions, and corrective actions, the authority issued its final order. The key direction was that the company would not be permitted to commence or conduct any business activities until it fully complied with all applicable regulatory requirements. These requirements include maintaining the prescribed net worth and infrastructure standards under the applicable IFSCA regulations. The authority effectively placed a restriction on business operations until compliance is restored. This approach reflects the regulator's objective of protecting market integrity rather than imposing an immediate punitive penalty. The order ensures that market participants operate only when they meet the minimum standards necessary for safe and transparent functioning within the IFSC ecosystem. This case offers several valuable lessons for all IFSC regulated entities. First, obtaining registration is only the beginning. Compliance obligations continue throughout the life of the registration. Second, minimum net worth requirements must be maintained continuously and not merely at the time of registration. Third, infrastructure requirements such as maintaining an operational office remain mandatory even if business activity has not commenced. Fourth, quarterly reporting deadlines must be strictly followed because delayed submissions can attract regulatory action and financial penalties. Finally, if an entity decides to exit the market, it should complete the surrender and closure process in a timely and transparent manner. Regulators expect proactive compliance and clear communication. This enforcement order serves as a reminder that regulatory obligations remain in force until registration is formally surrendered or cancelled. For compliance officers, stockbrokers, and IFSC participants, this case highlights the importance of maintaining strong governance, timely reporting, and continuous regulatory compliance. Moon Sales and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City in India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management. Renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations, and fintech. Expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network. Scan the QR codes below to stay connected with us.